name is Mariano Rivera. I'm a Major League Baseball pitcher for the New York Yankees. Possibly going into the Hall of Fame. When I'm on that mound, I throw split-fingered fastball, a cutter. Originally, there was one pitch, a lot of late movement, about 94 miles an hour, and I'm here to shut you down. When I'm on that mound, I earn $7 million a year as the closer. I am a money manager on Wall Street. Get paid on the 1st to the 15th of every month for my timing and my selection skills to professionally manage your assets and change your net worth and your financial life in the form of commissions. I am a waiter at the Green Street Cafe in Soho. We all wear black on black on black, very trendy night spot. And I come in at 4 p.m. I work until 4 a.m. and I run around that restaurant like a gazelle, giving you the best service I possibly can. And I earn tips. I am qualifying a certain level of income for you. The income that I'm qualifying for you is the income from the nature of your career and or job. Whether that income is in the form of commissions or tips or salaries. That income is reportable to the IRS and disclosable and is subject to a tax liability. In this country, income and gains are taxed. It's the third day of your training program, and I'm moving first into the area of the tax ramifications of securities transactions, and of gifted stock, and of inherited stock, and of convertible securities. And then I'm going to blast you with IRS trading tax law rules and regulations so that we can use this day and this entire week as the springboard into week 2, which is strategy week, and I'm going to really light up those educational afterburners. Are you ready to trade with me? Yes. Listen carefully. In this country, we are in what is known as a progressive tax system. That means that progressively, thank you, Raluca, wonderful, the more money you earn, the higher your tax liability. The less money you earn, the less your tax liability. Now, the IRS is going to place us into any one of 5 marginal tax brackets that we have. And based upon your tax return filing, you will be categorized into any one of those brackets, and that will be the percentage of the tax liability that you will have to pay on the income that you've earned from the nature of your job. Whatever that bracket might be. Whatever that level of income was reported to the IRS. So when we talk about the tax treatment of earned income, we know that Series 7, it is taxed just like ordinary income is taxed. How is ordinary income taxed? In your bracket, Series 7, whatever that bracket might be. So when I ask you from now on, week 2, how is earned income taxed, I want 2 little letters from you. At the OI level means at the ordinary income tax bracket level, whatever that bracket might be. That is how earned income is taxed. Are you with me so far? Yes. Now, look at me carefully today. I have another type of income I'd like to share with you. It is the income from my portfolio. Look at me. Look at my portfolio. Here it is. I own 1 share of IBM common stock and 1 Disney corporate convertible bond. That's my portfolio. Boy, am I proud of it. Now, I want to tell you what my IBM common stock investment pays me. It pays me a cash dividend. And only cash dividends, unlike stock dividends that we saw on Wednesday, represent income. And income and gains in this country are taxed. Agreed? Yes. I want to tell you what my convertible bond pays me. It pays me interest, and that's income. And that's always going to be subject as well to a tax liability. Are you with me so far? Yes. Now, the investor dies. Are you listening to me? I said I died. I want you to look at my portfolio now, one more time, differently. Will that stock still continue to distribute out and pay out that cash dividend, and will that bond still continue to pay out that interest? The answer is yes. The investor is doing nothing to actively earn that income, like he actively had to earn in the income from the nature of his job when he went to work every single day. Are you with me so far? Yes. This income is being generated from the nature of the securities themselves. Am I right? Yes. The portfolio, the investments. And so the investor is not earning this income like he was when he was earning the income from the nature of his job. And that's why these 3 words that I'm about to give you are all synonymous with one another that you must know. I am referring to unearned income. What is unearned income? It is also known as portfolio income. What is portfolio income? It is the income that's coming from the nature of the securities. Look at me. Or 7. or from the investments themselves, which is the stock and the bond. Am I right?
Yes.
When I talk to you about unearned income, portfolio income, investment income, I am referring to 7 cash dividends on stock and interest income on bonds. Never forget it. So that's what we're talking about now. The tax treatment, please look, the tax treatment of unearned income. What I am asking you now is, how is unearned investment portfolio income taxed? What do I mean? What I'm asking you is about the tax treatment of the cash dividends on stock and the interest income on bonds. I want to know how that's taxed. Now, before you answer, let's just back up one more minute. How is earned income taxed? Give me the 2 little letters right now. NOI. Say it to me. You're going to be a broker. I want to hear you. NOI. In your bracket, right? Good. Now, look up. How is unearned income taxed? What I am asking you for is the tax treatment of how those cash dividends on stock are taxed and how the interest income on bonds are taxed to the investor. How is that taxed? Well, now, wait a minute. Now, hang on a second. Take a time out. Let's take a time out, okay? We have our colleague here, Joe, from Staten Island. Joe said long-term, short-term, doing this with his hands, real wonderful. You're going to be great in Atlantic City. Were you ever a croupier? Look, long-term, short-term is a holding period. It is not a tax treatment. No, but thank you very much. I appreciate your response. One more time. How is cash dividends taxed and how are stock bond interest taxed? How is portfolio income taxed? You know how earned income is taxed? OI. How is unearned income taxed? Now you're giving me a tax treatment. I'm sorry. How is the cash dividends on stock taxed to the investor, and how is bond interest taxed? I'm sorry. You don't have to whisper. You know, because when we whisper down here, well, then we have to do whispering comments. You know what I mean? I can't hear you. What? Now you're talking to me about a period of time, but you're not talking to me about a tax treatment. But that's not a tax treatment. It's a timing that you're discussing. Well, obviously, you know, we were prepared for one chapter today, but we already have a problem. But that's okay, because I know you don't know. I was hoping that you would. So we learned a lot from you this week. Shall we determine what you've learned this week? I'd like to review a little bit. We can't convert, dilute, or add, but you got me, so don't worry about it. Now we've learned that we can't read. I mean, it's just unbelievable what's really going on over here. I'm going to tell you why. Because if you look in the section that we're starting out with concerning portfolio income, it says that the tax treatment of unearned portfolio investment income, look at me, depends on the nature of the security that you're long. Which means what? Well, that's what you supposedly had read last night. The different securities bear and represent a different tax liability to the investor. Are you with me so far? Yes. And so let's see what we didn't know from last night. And begin with that portion of portfolio unearned investment income known as the interest income on bonds. Are you with me so far? Yes. Let's handle that first. Now, this is mostly a prerequisite for NASDAQ, and we need to know it to get ready for week 2. You remember I told you that in my portfolio, look at me, I owned a convertible bond. Although convertible, it was a bond. Are you with me so far? Yes. What type of bond was it? IBM convertible bond. Are you with me so far? Yes. That's a corporate bond. Are you with me so far? Yes. Corporate bonds represent a Series 7 Bullet 1 tri-tax liability on the bond interest it pays to the investor. When you go out and buy corporate bonds, you are subject to a federal, state, and local tax liability on corporate bond interest. It is the only Series 7 tri-taxed instrument that we have in the market that you must know. So when we talk about tri-taxed securities, and we will in week 3, are you with me? Yes. We're talking about what? Corporate bonds. And you have to pay a federal, state, and local tax liability on that bond interest income to the corporate bond investor. Are you with me so far? Yes. Are you with me so far? Yes. Corporate bonds are tri-taxed securities. The second type of bond, of course, is the municipal bond. If you go out and stay long municipal bonds, and you're going to find out right now why most accredited money will have a very quick movement of capital into building a municipal bond portfolio. You are Series 7 Bullet 1, federally tax exempt on municipal bond interest, which is the big tax bracket, am I right? The largest one, am I right?
Yes. Yes.
And so right there, what do you know? If municipal bond interest income to the muni bond holder represents a federal tax exemption, then it's a tax-sheltered investment right there. You're sheltering income without having to pay a federal tax liability. Am I right?
Yes.
And what else? The state tax liability will also possibly be exempt to the investor if The investor lives in the state of the issuer, Series 7, which means what? Well, look up. Look up. Your client lives in Gramercy Park, New York. It's a very ritzy part of Manhattan. Are you with me so far?
Yes.
There's a fabulous restaurant there called Sal Anthony's, owned by friends of mine out of Rome. Probably the best penne arrabbiata in New York City. But let's talk about something else. That's where your client lives in a brownstone there that's worth about $14 million. You buy him a New York State Thruway municipal bond paying 8% interest. Are you with me so far?
Yes.
Is it a muni? Yes. Is he exempt from federal tax on that $80 a year in annual interest income? Yes. Does the bondholder live in the state of the issuer? Yes. He also, Series 7, is exempt from a state tax liability on that 8% yield on that bond. Are you with me so far?
Yes.
Forget about the local tax liability. I mean, it's so insignificant, it's not really worthy of mention. So what does that mean? It means that if the bondholder, I'll say it again, lives in the state of the issuer, look at me. Now watch my language now, but you got to look up. Then that bond is distributing and paying out a net return. That bond is paying a net yield. That bond is paying net investment income. If I use one of these three words, I'm either referring to the cash dividends on stock or the interest income on bonds, and you know I'm talking about interest income on bonds. Am I right?
Yes.
For that bond to pay out net investment income means that that bond is going to pay out to that client $80 a year in his 8% yield in investment income, in bond interest, net of, without a tax liability incurred. That is a net return because he's exempt from federal and state tax on the interest income because it was a municipal bond and he lived in the state of the issuer. That bond pays a net 8% return to the investor. You with me so far?
Yes.
Net of, without a tax liability incurred. No federal, no state tax on that $80 interest income distribution every year. You with me so far?
Yes.
That's an investment with a net return. Mr. Johnson, you realize I have a bond that pays 8%? The bondholder lives in the state of the issuer. Do you realize, Mr. Johnson, you have no tax liability on 8%? That's 8% net to you in the market. Are you with me so far?
Yes.
No taxes, no taxes, no taxes. 8% net to you. He'll think you're fabulous. Are you with me so far?
Yes.
I'll make him think you're fabulous because you are fabulous. Show me an investment out there that pays an 8% net return without a tax liability incurred, and I'll commit $750,000 in capital immediately to it. Are you with me so far?
Yes.
Especially an investment that protects my principal at the maturity of the security without any capital loss. Are you with me so far?
Yes.
You will diversify his common stock portfolio into a bond position because I'm going to show you how to build it. Oh, God, I'm getting excited. This is crazy. But if your client lives in New York and you buy him an 8% new California freeway municipal bond, is it a muni? Yes. Is he exempt from federal tax liability on the 8%? Yes. But does he live in the state of the issuer? No. And then he would be subject, Series 7, to a New York state tax liability on that bond interest of 8%. The state tax liability is based upon residency. 7! Just take what I give you and run with it. Because you're going to score a touchdown, I promise you. Oh, if I don't beat Dallas on Sunday night, I'm going to go crazy. I hate Dallas. Sure, see, he lived in New York. He lives in New York, and he bought an 8% California freeway municipal bond. Now, it's a muni, so he doesn't have to pay a federal tax liability on the $80 in bond interest income, but he doesn't live in the state of the issuer, so he has a state tax liability, a New York state tax liability, because he lives in New York, not a California state tax liability. The issue is California. He lives in New York. So the state tax liability is based upon where he lives. Are you with me so far?
Yes.
And that bond does not pay then, therefore, a net return, because there is a state tax liability on that bond interest. Am I right?
Yes.
So it is only when it is a municipal bond and the bondholder lives in the state of the issuer will the return be a net return. Are you with me so far? Net of a tax liability incurred. Thank you very much. Wow. This is crazy. Well, a lot of people think they can come to me anytime and they can, except for this particular period of time. This is just for you. Well, what about government bonds and government securities? Series 7, Bullet 1. Subject to a federal tax liability on the government bond interest, exempt from state and local. Series 7. So what do you know now? You know that bond interest is taxed differently, right? Here's the answer. How? Depending upon the nature of the security that you long. Different bonds represent a different tax liability. Am I right?
Yes.
Now let's take a look at right now that other portion of portfolio income known as the cash dividends on common stock investments. Are you with me so far?
Yes.
How are they taxed? Anybody?
OI?
Correct. Series 7, thank you. Jose? It is only, please look up very carefully now, only that portion of portfolio income, investment unearned income, known as the cash dividends on stock, that is taxed just like earned income is taxed at OI. So when we say in summation that the tax liability of portfolio income differs depending upon the nature of the securities that you're long, that's only for bonds. With respect to the tax treatment of the cash dividends on stock, are you with me so far? Yes. That is taxed just like earned income is taxed in your bracket at OI. Are you with me so far? Yes. So now what do we have? We have the tax treatment of earned income, of unearned income, and now we move into the tax liability, the tax treatment of deferred income. Are you with me so far? Yes. Deferred, what does that mean? Look at me. Put off to a later date. That's the word deferred. Are you with me so far? Yes. Well, look at me. In week 3, on Monday, we're going to establish a portfolio for clients that will complement its common stock investments from a trading point of view on the retirement side. We're going to show you, I'm going to show you, how to build money on a self-directed basis with your custodial advice and move that money into the IRA. And manage retirement assets. A little bit different of a philosophy, as you could probably surmise. Are you with me so far? Yes. We're going to complement the IRA investments and your recommendations to the IRA on a conservative approach for retirement money with the building of variable annuities and fixed annuity investments, and then we're going to move into your investment advice that you'll be given to clients regarding his private sector investments that he has with his employer associated with pension and profit sharing and 401k, and show him to get back some of that loss in the value of the 401k in this particular marketplace, which is what your concerns should be, because those are his concerns. Are you with me so far? Yes. And then we're going to move into some exciting strategies on that particular day as I give you something a little bit more than just the 7 itself, and that's showing you how to build a portfolio according to what is called the modified portfolio theory, and then I'll move you into asset allocation trading strategies and techniques to start going into managed assets to complement your transactional business of brokerage. Are you with me so far? Yes. I'm going to take you to a level educationally that I just can't even qualify until I teach you. It's out of sight, off the hook. But you know, with me? Yes. When your client has investments in an IRA, a retirement account, and if he should establish that investment at 47 years old because he has the vision and he knows he's concerned about his retirement, he might have liquidity at 47, that by the time he turns Series 7, 59 and a half, which is the definition of the age of retirement. Did I say 60? No, I said 59 and a half. Then he might need to go into that retirement account at that particular point in time. He's not compelled to, but he might need to, especially today's level of inflation and the economy's landscape, to start drawing money from that IRA to supplement his loss of earned income or even just keep apprised of inflation. Are you with me so far? Yes. Or maybe to fund educational funding for his children at that particular point in time if the timing mechanism is working out for him that way. Are you with me so far? Yes. If that be the case, well, listen to me carefully. While income is being earned in the IRA each year, there is a zero tax liability incurred to the investor. You see, you're only taxed on the income that is earned in the IRA account, the retirement account, when you pull money out of the IRA. And the idea being, under isolated and ideal conditions, that the client will pull money out of the IRA when he approaches retirement. Because prior to retirement, you can pull money out of the IRA, but as you'll see when we study in the education and the theory, you'll be subject to significant and severe tax liability penalties. Are you with me so far? Yes. So it's unlikely, although he could. She could. So if the client pulled the money out of the IRA when he approaches retirement, not prior, are you with me so far? Yes. We just said that we're in a progressive tax system, that the more money you earn, the higher your tax liability, and the less money you earn, the lower your bracket, the lower your tax liability. And so under normal circumstances, not all circumstances in the market, the idea being that when the client approaches almost 60 years old, and there is a considerable loss of his earned income in the private sector. She is not earning the $1.4 million or the $250,000 that he was earning or she was earning when they were 47 years old or 50 years old. Are you with me so far? Yes. Not necessarily the case under all circumstances, but usually more often than that. And that would mean that when the client approaches 59 and a half, he's in a lower bracket. Are you with me so far? Yes. Than he was when he was 42, earning more money in earned income. And so therefore, when you pull money out of the IRA at retirement, that's when you will be taxed in your bracket at OI, whatever that bracket might be. And so what do we know about the tax treatment of deferred income, which is income that is deferred in a retirement plan? It is Series 7, Bullet 1, taxed deferred to the investor to liquidation when he pulls out. At OI, 7. The tax liability of income that is deferred is tax deferred. Income that is being generated in the IRA is not taxed until it's put off, it's deferred, until he pulls money out, and that is at 59.5, and every month thereafter when he starts liquidating out of the IRA or any of the retirement plans. Are you with me so far that we have and will establish? And so tax-deferred income is tax-deferred to liquidation at OI in your ordinary income bracket. And so now, and we'll get to that on a more detailed basis when we get into the retirement side. Basic tax law, rules, and regulations are what we're covering right now. You with me so far? Yes. Tax treatment of earned income, unearned income, deferred income, and now I want to talk to you about the definition of what are called capital assets for NASDAQ. Capital assets are securities. There are 4 primary capital assets on the 7. Please look at me. They are 7. Bullet 1, stocks. Bullet 2, raw land. Bullet 3, commercial real property. And bullet 4, bonds. Stocks, bonds, raw land, commercial real property are known as and defined as the IRS code capital assets. Are you with me so far? Yes. So, I want to talk to you about these capital assets. Are you with me so far? Yes. With respect to the latter two, raw land and commercial real property, look at me. You're going to see them over staggering levels of 3 hours of training when we get into tax shelters on Monday, and I can't wait to get there. So while you have a fabulous weekend and the weather's going to be great, please know you're coming into 45% of NASDAQ, and I will be waiting for you. Anyway, that was my way of saying have a great weekend. You can have a great weekend, just know you've got to come back, and I'm going to be waiting for you, and we're going to kick it up, and I can't wait to kick it up. Yeah, we'll get into raw land and commercial real property next week. And because this is stock week, why don't we use this particular capital asset as the capital asset of concentration, the almighty equity. Are you with me so far? Yes. And so I want to talk to you about a client that goes out and trades a position in a stock. Are you with me so far? Yes. And I want to talk to you like a financial advisor. So are you ready to trade with me? Yes. Excuse me. Just got to get my Stradivarius out. Thanks so much. You're very kind. Client goes out and accumulates a position in a stock at a cost of 20 per share. That 20 per share is known as SIP, your cost basis per share. The basis of the client's cost on a per share basis. Are you with me so far? Yes. His capital risk, however much money he spent to go long the security. You bought the idea that was oversold and undervalued at support price. Thank you, technical analysis and language from Wednesday. I'm here to haunt you. Because you believe it is undervalued and it has all of the potential for appreciation. Are you with me so far? Yes. You were right. Over the next forthcoming weeks, the stock price appreciates in value and it's trading at 25. Broker calls up the client. He says, liquidate the position in the stock. You sell the stock. Capture 25 per share. Sale price. With me? Yes. What was generated was a $5 capital gain per share times the number of shares that were liquidated to the open market. Are you with me so far? Yes. What is defined as a capital gain? It is, what's the very first word I say? The sale of a capital asset, stock, at a sale price per share that was higher than the cost basis per share. Are you with me so far? Yes. The original cost basis here is the original price that the client paid to go long the stock. What price? 20 per share. Are you with me? Yes. Everything is quantified on Wall Street on a per share basis. Agreed? Yes. Yes. Now I want to define something else for you. A capital gain, but I want to use different language for you. Client goes long this stock at a cost originally of $20 per share, cost basis per share. This $20 per share is known as his original cost. Are you with me so far? Yes. At the time that the client was long the stock, are you with me so far? Yes. Board of Directors forward splits the stock 2 for 1. What do you have now? A dilution into the stock's price. Your client owns double the amount of shares at a now reduced and adjusted and diluted cost basis of $10 per share, adjusted cost basis per share, that was adjusted downward as a result of dilution into the stock because of the forward split. Agreed? Yes. No change in valuation, but now he owns the stock at an adjusted basis of $10 per share. The stock is now trading in the market at $15 per share. The client sells the position through you, the financial advisor, and what was generated now is a $5 capital gain per share, but the language is a little bit different. And this $5 capital gain per share was generated because you captured and sold that capital asset at a sale price per share of $15 per share that was higher than the Series 7 original cost base, adjusted cost basis per share of $10 per share that the client now owns the stock at as a result of dilution into the stock's price. So why don't we put the language of the generation of capital gains transactionally into one setting? You will generate a capital gain for any client on a securities transaction on a per-share basis if you, through trading, capture and sell that security, that stock, at a sale price per share that is higher than the original cost basis per share, or possibly higher than the client's adjusted cost basis per share that might have been adjusted downward as a result of dilution to the stock. Are you with me on the language? Stay with me on the language. Now, in the trading of this stock and the generation of capital gains, the IRS has a different tax treatment for capital gains. Are you with me so far? Yes. Than we do for earned income or unearned income. Are you with me? Yes. We're into tax law trading rules now. Short-term capital gains are taxed Series 7 at the 35% ordinary income tax bracket level. Hold on. You got to really listen to what I'm saying. I'm going to say this again, and I want you to hang on every word I say to you. I said short-term capital gains are taxed at the 35% ordinary income tax bracket level. Ordinary income tax bracket level. The 35% tax rate, are you with me so far? Yeah. Is not technically a capital gain rate. What is it? It is the ordinary income tax bracket rate high, one of the 5 marginal tax brackets set forth by the IRS based upon your tax return filing. Are you with me so far? Yes. Which sounds to me and you is like how earned income is taxed. Remember we said there were 5 marginal tax brackets that we have? And based upon however much your tax return you filed was, you would be categorized into any one of those brackets, and that is the tax treatment of your earned income. Are you with me so far? Yes. Okay. The lowest of those brackets is 15%. The highest of those brackets is 35%. Are you with me so far? Yes. These are ordinary income tax bracket levels. The IRS is going to take the highest tax bracket, 35%, and tax you on short-term trading profits. Are you with me so far? Yes. That means even if you just got out of college, listen to me carefully, and you didn't even started working yet, you're in the 15% tax bracket rate. You do a capital gain transaction short-term, you're taxed at 35%, regardless of your bracket. This is how short-term capital gains are taxed. They're going to take the biggest portion of the gain. Are you with me so far? Regardless of your bracket, if it's a short-term capital gain. What is the definition of a short-term capital gain? It is any gain that was generated for a stock that was held and then sold for a period of time, of 1 year or less. From what date? Trade date. Everything operates from the basis of the trade date. Are you with me so far? You go out and buy that stock, and then you liquidate that position, and you generate a gain. Are you with me so far? A capital gain for stock that you owned for less than a 1 year period of time. That is a short-term capital gain. Mike, you with me? Yes. Okay. My dog Brandy does that. I got a puppy. You believe this? I got a goldfish, I got a squirrel, and I got a puppy. I got 3 kids I can't handle. It's like a farm in my house. Oh, my God. Brandy does that. Inquisitive. I go, what do you want? You want to go out? What do you want? Look at me for a minute. Look at me for a minute. I'm going to say this again. What I'm trying to impress upon you is that the IRS will tax those short-term trading profits and short-term capital gains, regardless of your bracket or earned income. This is capital gain transactions now at the 35% ordinary income tax bracket high. You can be in the 22% income tax bracket based upon your tax returns. It's irrelevant. The tax treatment of earned income, capital gains, short-term, 35%. Are you with me so far? Yes. So my point to you is that the 35% tax bracket liability and gain on short-term gains is not a technical capital gain rate. Are you with me so far? Yes. It is the ordinary income tax bracket rate of 35% OI high. Are you with me so far? Yes. Now, before I get into the long-term capital gains tax rate, you have to listen to me now. The IRS has come out with many amendments to the tax law and changes, and I suspect that we all agree that this particular administration, based upon what's gone on in this economic crisis, which was the worst in 77 years, are you with me so far? Yes. Will change the tax code many times then thereafter. There's no question about it. Change brackets around, come up with certain incentives. We already have some in place from Bush, and we'll get through that and discuss those incentives in his re-election for his second term concerning the George Bush economic boom package that was designed to win him re-election to beat out Kerry for a second term, to the tax treatment of certain investments in IRAs, where we can pull money out prior to retirement without incurring penalties to be able to support educational funding and buying our first-time home and medical costs that we never had before. But I'm sure that there'll be many more amendments coming down right now with dramatic changes to the tax code. Are you with me so far? Yes. Probably even shifting around some of the brackets, maybe lowering some of the brackets so that we can lower the tax liability to the middle class. Many things happening, I'm sure. But in 1986, there was a staggering regulation that was passed by the IRS law through the Senate and the Congress, was called the Tax Reform Act of 1986. Try to remember the 80s, even if you weren't in industry. We had what were very frivolous times in the market, very inflated days. Are you with me so far? Yes. Inflated economy, inflated stock prices, inflated real estate levels, completely the other end of what's going on right now in the economy today. We also had what was called the 3-martini lunch. I don't know if you know what that meant. It meant that you cut deals over cocktail napkins over a liquid lunch. Most deals were cut in restaurants and in bars over liquor, and we call them a martini lunch. And we call that martini lunch a martini lunch because we took the costs of those entertainment fees and we wrote them off. Are you with me so far? Yes. We were writing off our suits, we were writing off our socks, we were writing off our ties. We wrote off just about anything we can get our hands on as a deduction against income. And the IRS says, look, this has got to stop. We've got to tighten up this tax code. We've got to end the 3-martini lunch. We have to eliminate these frivolous deductions and try to recapture some money back in tax revenue and tighten up our tax code. Are you with me so far? Yes. So they came up with a staggering amendment in legislation to the tax code in the country called the Tax Reform Act of 1986. Now, there have been other reforms, are you with me so far? Yes. But none quite to the impact this particular amendment had to the basic tax code in America. Because when the Tax Reform Act of 1986 came into play, that legislation, it changed dramatically the tax code that we had in the country, more impactful than any of the legislation to date. It ended the 3-martini lunch. It came up with the alternative minimum tax, which is another way of computing the tax liability on earned income based upon the traditional method, and the larger of the two tax liabilities is what we would pay. You with me so far? Yeah. Which destroyed Wall Street's financial advisors because we always had the higher income, and so we always paid the tax liability according to the ATM. Are you with me so far? Yes. Good. Now, we also, in that Tax Reform Act of 1986, saw what the IRS did to certain items, investments that were tax exempt. They made them now tax preference. Are you with me so far? They came up with regulations that changed the long-term capital gain tax rate as well. The long-term capital gains tax rate on a long-term capital gain that was generated for stock that you held and then you sold for a period of time of 1 year or greater from your trade date, which is the holding period, are you with me so far, was 28%, then slashed to 20. Look at it now. Because of that amendment, 15%. And it's probably going down to 10. What is the 15% rate known as? The lowest of all of the marginal tax brackets. Are you with me so far? Yes. So if you're in the 35% tax bracket liability rate on your earned income, but you generated a long-term capital gain, you're only going to be taxed on 15% on that long-term gain. You with me so far? Yes. When Congress passed the amendment for the IRS to the long-term capital gain from 20% and slashed it down by 5% to 15%, Wall Street did this. Thank you, Congress. Thank you, IRS. We supported the reduction of the long-term capital gain tax rate. We wanted it desperately. Why? What message, look up, stay focused, is Wall Street trying to tell investors regarding the support of the reduction of the long-term capital gain from 20 to 15%? What are we trying to tell investors? Joe, hold your stock longer. Save yourself a 20% tax liability on the gain. Why do we care how long the client holds his stock? Because by holding the stock longer, and there's a staggering inducement right there, not only, as I'll promise you, I'll educate you right now on, your client will generate higher returns. Are you with me so far? Yes. And save himself a 20% tax liability on the gain as opposed to paying a 35% tax liability on a short-term gain. You with me so far? Yes. But that, by inducing him to hold that stock longer, and there's the inducement, are you with me so far? Yes. The savings of the 20% tax liability on the gain, are you with me so far? Yes. It would contribute towards a lower level of short-term trading profits and short-term stock price volatility. You see, let me tell you what was originally going on Wall Street in the 70s and the early 80s. Are you with me so far? Yes. Even in the 60s. When we got on that phone and we issued a recommendation recommendation to a client, the recommendation was always based upon, Mr. Johnson, I'd like you to hold a position in that stock for at least 12 to 18 months over the long-term basis so we can really see true value tied to the appreciation of the stock price, tied to the true earnings of the company over a 4-quarter year. So at least 12 months, let's hold on to that stock and allow this company to grow, show us its earnings, so that when we do liquidate the position, we can liquidate at a value that is not inflated but tied to its earnings. We always sold over a long-term hold recommendation, and then what happened? Well, then I'll tell you what happened. Technology stocks came into the market, only so far, yes. And they started to fly up and down like an emu eel. Are you with me so far? And Maury eel, you know, up 14 points, down 3, and so she started to say to the client, you know what? Wow, we can capture a 7-point run in that stock. Better do it quick. And then she's going down, maybe you're short on that side as well. Let's trade these stocks because they move so quick. Because remember, we said that on Wednesday, we seek stock price volatility because that volatility breeds investment and capital gains on the bull or the bear. It's the stagnation of a consolidated market that represents a difficult period of time to make money because there's not much movement going on with respect to stock prices in the market. Am I right? We want that volatility. We seek that volatility. And so he started to trade stocks. He changed the marketplace from an investor market, where you held stocks for a long period of time, to a trading marketplace, which did what to stock prices? It made them even more volatile. When? In the short term. So, by inducing the IRS to reduce down the long-term capital gain tax liability, we're trying to induce the client to hold that stock longer so that he doesn't trade them on the short-term basis to allow the markets somewhere there, through that trading activity of long-term holding periods, a lower level of stock price volatility. Are you with me so far? Yes. That's the inducement. That's why we care how long he holds that stock up. Are you with me so far? Yes. And so therefore, the long-term capital gain is 15%, the savings 20%, which always has meant that the longer the holding period before liquidation, the greater the gain and net return to the client. Now that argument should satisfy that educational point, and that yes, the longer you hold that stock, the greater the net return and the savings of a 20% tax liability. Had you sold that stock for short-term trading profits, are you with me so far? Look at the erosion of those short-term trading profits by capturing a 2 or 3 point movement in the stock on the short term. He's got to pay first the 35% tax liability to the government croupiers. Are you with me so far? And what about the Wall Street croupiers, which are us? We charge them a 5% commission above the offer. Are you with me so far? Watch the erosion of these short-term trading profits. And then there's SEC order handling fees and maintenance fees and ticket charges. By the time I'm done with that 2-point appreciation and gain on that stock on a short-term trading profit, I'm going to possibly lose to the client. He's going to lose 40, if not 47% of that return. Are you with me so far? Yes. Just because of a 35% tax liability to the government on the gain. Are you with me so far? And of course, the transactional fees that he has to pay Wall Street. Had he held the stock for a longer period of time, he'll have a greater net return because stocks appreciate much significantly more over a longer period of time than over a short-term trading profit point of view, and save himself a 20% tax liability on the gain. Are you with me so far? Yes. So that means that the longer the holding period, the greater the net return. Agreed? Yes. The longer the holding period, the greater the net return. Well, let me give you a couple of other arguments and cases in point that support the educational point that the longer the holding period, the greater the net return. Aside from the savings of a 20% tax liability on the gain, because you only taxed at 15% versus 35% on short-term trading profits. Now, let's talk about the rule of 7. Argument number 1. Please listen. The rule of 7 says this. $7,000 invested at 7% yield for 7 years will generate an overall $70,000 principal and interest return. You don't have to agree with me or not. That's a mathematical fact. The rule of 7. Argument number 1, that the longer the holding period, the greater the net return to the client, as opposed to the erosion of short-term trading profits through short-term capital gains tax liability, says $7,000 invested at 7% for a 7% yield will give the client an overall $70,000 principal and interest return. Okay? You don't like the mathematical rule of 7? Good. Let's forget that rule. Let's go to another argument, case in point, that supports that the longer the holding period, the greater the net return. It's 1986. Look at me. Not your books. Look at me. I'm here to help you. And you forgot that you had some liquidity. $10,000 lying around a little bit. You took $10,000 in 1986 and you bought Microsoft common stock. You forgot about the investment. You forgot about it for 10 years. Now it's 1996. How much was the $10,000 investment in Microsoft common stock worth? Take a guess.
Over 100,000.
Oh, really? Okay, let's go a little higher than that. 1.5 million. It's ridiculous. I would cut somebody's heart out for that kind of return. I don't know about you. $10,000 10 years later is blowing up to a valuation of 1.5 million. The performance that this stock has executed in the market, we said, was like lightning in a bottle. No security in the history of Wall Street's 200+ years of trading has ever performed like Microsoft. Now, what did it do that was so exceptional? Well, for 10 years in a row, exceptional performance number one for this stock. It came out with record and unbroken earnings for 10 years in a row. No stock has ever for a decade in a row come up with record earnings each year. Right there alone, it qualifies as lightning in a bottle. For each one of those 10 years, that stock forward split that kept giving investors more shares, more shares, more shares, each shares for a decade that he didn't have to pay for, increasing the valuation of a portfolio from $10,000 to almost $1.5 million 10 years later. Oh my God. Okay. So we really can't use the argument about the longer the holding period, the greater net return with Microsoft because of its unusual performance in the market. And so I'll give you a traditional argument and finally end it right now that supports the educational point. I'll say one more time that the longer the holding period, the greater the net return. In 1956, Coca-Cola went public at $22.50 a share. Are you listening to me? Yes. Grandpa gave you one IPO share from Coca-Cola's underwriting in '56 through an inheritance. How much is it worth today? More than $7 million. Look at me. One share! I don't know if you understand where you are or what I'm saying. 50 years plus of the splittings of stocks and dividend distributions and the valuation of over a half a century later. The longer the holding period, always the greater the net return. Are you with me so far? Yes. Never forget. And the savings of a 20% tax liability on that gain, right there alone, mathematically, would give the client a higher net return than short-term trading profits. And I know it's very difficult to tell your client, Mr. Johnson, I know you see a four-point rise in that stock, and that's significant relative to the number of shares in the position that you own, and why not take it? But let's take into consideration what the net return would be after a 35% short-term capital gain, 5% agency transactional fees, and other fees that you're going to have to take associated with the generation of that gain that could erode your profits considerably over the short term, when I think we should maybe only take part of the gain by selling only portion of the position and stay long some of the stock to appreciate over a longer period of time with the right investment advice. Are you with me so far? Yes. Do you know what is necessary in order to generate a capital gain? Yes or no? You didn't sound too confident about that one. You need two numbers, am I right? It's okay. You need two numbers, am I right? Yes. You need the cost basis per share, you need the sale price per share. What number do you need first? Right, because without knowing the price that he owns the stock at, are you with me so far? Yes. Then you can't determine if there's a gain or a loss. I mean, if I told you the client liquidated to you, through you in the market, 1,000 shares of GHII at 38.25, we can't determine if there's a gain or a loss on a per share basis unless we know the price of ownership. Cost basis per share, Series 7, is ownership. I need you to know that. That's the price you own the stock at, or the security, am I right? Yes. For stock on a per share basis, am I right? Yes. Okay, so now, because we need to establish the cost basis per share for every investment, you have to know the price that he owns the security at first, am I right? Yes. So that based upon when he does sell through you and liquidate, there is, based upon what that sale price would be, to compare it to the cost basis from a trade confirmation point of view, the ability to determine if there's a gain or a loss, am I right? Yes. So, I am now, look up, going to move now into the establishment of the cost basis, which is the first and most important critical number for the following transactions. Convertible securities for the common stock per share after conversion that we said we would save for today to determine if we should recommend conversion to the client. Look up. We said we would only recommend if the client had a convertible security, the ability to convert on conversion day, if he ended up, watch my language now, look at me, owning the shares of common at a cost basis per share after conversion that was cheaper than the market price of those shares. Why? Because only then would you be able to then take the common stock portfolio that you now have after conversion and then blow it out to the open market to generate a capital gain on the transaction. If it does not end up owning the shares of common at a cost basis per share after conversion of converting the convertible security into common that's cheaper than the market price of common, do not convert and sit back and stay long and earn your 9% yield on your convertible bond. Am I right? Yeah. So today we will establish, as we promised, the cost basis per share of the common portfolio after conversion to determine if we should convert. And then we will move into the cost basis of a client who receives stock as a gift. Client calls you up and he says, I got stock as a gift. Are you with me so far? Yes. What price do I own those shares at? The price of the stock trading in the marketplace, or the price that the stock was given to me by the donor as a gift. I mean, we have to establish, because down the road he's going to sell that gifted stock, and when he sells that gifted stock, from a trade point of view, you have to compare it to the cost basis of the gifted stock to determine there's the gain or a loss. Am I right? Yeah. What happens if the client receives stock through an inheritance? What price do I own that stock at through the inheritance? Was it the price that Aunt Florence paid? Are you with me so far? Or the market price of the stock at the time that she died? I mean, so we need to establish inherited stock's cost basis as well. Are you with me so far? And so I am now going to move into establishing, please listen to me, the most important number that you have to establish first: ownership. Cost basis per share. Once we have that, then in trading for part or all of a position, are you with me so far? Yes. We always compare the sale price to the cost basis per share from a trade confirmation point of view to determine if there's any potential capital gains or capital losses on the transaction. Am I right? Yes. And we can't do that unless we know the cost basis per share ownership of the stock. Are you with me so far? Yes. Or of the original security. And so you read about last night that your client invested in one $1,200 RFQ convertible bond. The $200 over $1,000 is known as a premium price. This would be known as a premium bond. Don't worry, we'll get the bonds, and we'll talk about bond pricing and valuation of bond week. Are you with me so far? Yes. Buys a bond for $1,200. The price for the original security here is $1,200. The definition of the original security is the convertible bond. It's conversion day. Are you with me? Yes. He asked his broker if we should convert into common. How many shares of common will receive after conversion? And you read 40. Are you with me so far? Yes. There was a number they did not give you in the body of the work last night. Obviously, we know the number must be 30, because 1,200 divided by 30 gives us the number of shares of common after conversion. Am I right? Yes. What is that number known as? What is that number known as? Not what is the number. The number is 30. What is the number known as? Conversion rate. I'm sorry? Conversion rate? Conversion. Excuse me. This is the conversion ratio. What is that number known as? Conversion price. That's the word I want. This is the dollar par value of how much the original security was worth. This is the definition of the conversion formula. Am I right? Yes. This is how we convert any convertible security into common. Am I right? Yes. Let's get back into the formula again one more time, what these numbers mean. This is how much the price paid was for the original security. Look up. Look up. And that's the conversion price. When you take the dollar value of the original security, which is the convertible security, and divide it by the conversion price, you get the number of shares of common after conversion. Am I right? Yes. So the client says, if we convert that convertible bond into common, how many shares of common will we receive today after conversion? 40. He says, okay, where's that stock price trading in the market? Broker says 45 per share. You with me so far? Client says, sell the stock, convert the bond, sell the stock, and capture me 45 per share. Done! Gain or loss per share on the trade. Go. I converted the bonds into common. I received 40 shares of common after conversion. I then sold the 40 shares to the open market and captured 45 per share on the trade. Gain or loss per share on the transaction. Go. Gain. How much? Incorrect financially. Incorrect financially. Back up 2 feet. I received 40 shares of common after conversion. Are you with me? Yes. Client no longer owns the original security. He's now got 40 shares of common. Are you with me so far? Yes. He sells the 40 shares of common to the open market and he captures 45 per share. Are you with me so far? Sale price. Gain or loss per share on the trade. Gain. How much? Not 5. Don't go back to that number. I said it's wrong. Is there an echo in here? I heard you. $15 capital gain per share. Connecticut. Wow, am I excited. Anybody ever see the movie Top Gun with Tom Cruise? Yes. Let's talk about that for a minute. Who was Ice in the movie? Val Kilmer. Val Kilmer. Why do they call him Ice? Because he didn't make any mistakes in the air. This particular facility, and there is a Top Gun, are you with me so far? Yes. In the country, are the best fighter pilots in the world. And so the best of the best, the elite of the elite. Great movie. I thought it was great. I like movies like that anyway. And then there is Maverick. That was Tom Cruise. And he was so talented in the movie. What did he do? He inverted like a MiG 360, and he did moves with fighter pilot planes that most people couldn't do. But he was Maverick because he was dangerous. He'd do those flybys while the air traffic control people were trying to have coffee just to piss people off, right? But he was extremely talented. Are you with me so far?
Yes.
But very dangerous. So what did I say to him? You're dangerous, kid. I don't want you on my right wing if we have to go to combat. So Maverick is a name that I use, and I've been using for many years, for candidates who give me an answer to a question that is correct when they have the wrong rationale for it, which is very dangerous. Connecticut. Your first name, sir?
Mike.
Oh, Mike. Yeah, Mike from Connecticut. Mike, you couldn't be more right. On this transaction, there was a $15 capital gain per share. On the liquidation and the sale of 40 shares of common after conversion at a sale price of $45 per share. But in order for your gain to be correct on a per share basis, you must have known something that I didn't tell you. And that must be that he owns the shares at a cost basis of $30 per share. Because if he then sold the shares at $45 per share, if the gain is $15 per share, he has to own them at $30 per share in order to generate that gain. Now, my question to determine if you're Maverick or Mike, are you with me so far, is how did you determine that he owns the shares at a cost basis of $30 per share, that he owns those 40 shares at $30 a share? I'm worried about that 30, you see? That's what I'm worried about, because these two 30s are completely different. This is cost basis per share. This is conversion price. Are you with me?
Yes.
Just so you know. Anyway, why don't you quell my fears and tell me how you determined that he ended up owning the shares of common after conversion at a cost basis of $30 per share. Tell me. You use the conversion price, and that would make you Maverick. Thank you very much, and that's very dangerous, and I appreciate your honesty, because if you knew it, you would give me a different answer, and thank you very much. And that's very dangerous. And so does anybody know why we end up owning the shares at $30 per share? And furthermore, same question, only continuation, why the cost basis and the conversion price are the same mathematical number, even though financially they're two different interpretations. One is cost basis per share, and the other is conversion price per share, but why are they both 30? Or, more importantly, why does he end up owning the shares at $30 per share after conversion? Does anybody know? Well, that's okay. You don't have to know. You look frozen, and you look like you're watching some kind of MTV commercial. This is what you look like. I got to tell you, you look fabulous. It's unbelievable. I mean, you look like you're starstruck. It's either you don't understand what I'm talking about, or you're just so embellished, because there's an IRS regulation that you're not giving me. There's no calculation on NASDAQ for this area. This is regulation. Are you with me so far? Yeah. We'll have plenty of time for calculation when we get to Strategy Week, just not this week. Are you with me so far? Yeah. And that is that the price that your client ends up owning shares, the price that your client will own the shares of common per share after conversion, you have to establish the price he owns those shares at. Because without knowing he owns the shares at 30, you won't be able to determine if you liquidate the shares to the open market. Because if the stock is trading at 28 5/8, you will not recommend conversion, am I right? Because it's going to show a loss. Sit back and stay long, you're 8% yielding your investment. That's why we're going through this. Are you with me so far? You always have to establish the price your client owns the securities. Are you with me so far? And what price would he own these shares of common? You only recommend conversion if the stock price is trading anything above 30 a share. You with me so far? Yeah. Because he's going to own them at 30, and then you can sell the shares of 40 shares to the open market at that price, which is above 30, to show him the gain. Are you with me so far? By the way, the $15 capital gain per share times the 40 shares that were sold to the open market should be a $600 gain, taxed at either 15% or 35%, depending upon the holding period of the stock. Am I right? Yes. Now, the holding period of the bond, which was converted into the stock. Are you with me so far? You forgot the original security was the bond. Don't talk to him. Listen to me, because you just missed what I just said. I'm going to say it again. When you sell the 40 shares to the open market, are you with me so far? And capture a sale price of $30 per share, $45 per share. That's a $15 capital gain per share. On the 40 shares that are sold, it's a $600 gain. Am I right? Yes. You'll be taxed at either the short-term rate or the long-term rate, depending upon the holding period of the bonds, which was the original security that was converted into the common. Are you with me so far? Yes. Well, forgetting about that for a moment, we determine the price that your client owns, cost basis per share, the common per share after conversion, based upon the following IRS regulation. And that is the cost basis of the common per share after conversion must have the value of the common stock portfolio be equal to the price paid to the original security to establish Series 7 parity. That's the regulation. Now, before, I know you don't understand that, so I'm going to do it again for you. With me so far? Yes. Are you with me so far? Yes. Now, what does the word parity mean? What does the word parity mean? Well, it would mean equality. Are you with me so far? Yes. Right. Parity means not equal, but equality. Are you with me so far? Yes. Which is why, if you see the Cincinnati Bengals win the Super Bowl, are you with me so far? Who went 2-7 and barely made the wild card, that would be parity. Are you with me so far? When the Florida Marlins win the World Series, that would be parity as opposed to Boston or the Yankees or Los Angeles, if you will. Parity means equality. Now, what does the regulation say one more time? Well, what was the price paid? Look up here. I don't want you to look through your books. I want you to look over here because I'm going to make it easy for you. What was the price paid for the original security? You're really on a roll today. You know that? This is the original security. Am I right? Yes. Now, how many shares of common you receive after conversion? 40. The IRS rule says that the common stock portfolio, which now consists of 40 shares after conversion, must be equal in dollar value to how much you paid to the original security to establish parity. So that means if you paid $1,200 for the original security, and if furthermore you receive 40 shares of common after conversion, those 40 shares have to be worth $1,200 because that's how much you paid for the original security. The dollar value of the common stock portfolio has to be equal to $1,200. Are you with me so far? Yes. The common stock portfolio has to be equal in dollar value to the price paid for the original security. If the price paid for the original security was $1,200, and if furthermore you receive 40 shares of common after conversion, these 40 shares have to be worth $1,200. Therefore, you have to own them at a cost of 30 per share because 40 times 30 is equal to $1,200, which is why the conversion price and the cost basis per share are the same number mathematically. Are you with me so far? Yes. And always will be. And so therefore, you can always find the cost basis of the client's common stock portfolio per share after conversion mathematically. And that would be to take the price paid for the original security and divide it by the number of shares of common that you received after conversion, and that will always, 7, establish cost basis. Are you with me so far? Of common. And therefore, any market price of that stock trading above 30 per share, boom, do the trade, convert the bonds, blow the stock out, and show them the gain. Am I right? Yes. 7. It's wild, isn't it? But it's right on, man. It's right on. Are you with me? Yes. Well, we now have established our cost basis transactions. Very important to know the price of ownership. But unfortunately, over the last couple of trades, you show your client some losses. Not intentional, unless he wanted those losses intentionally as a write-off and as a deduction against earned income, because possibly he filed an extension for his tax returns and he needs some write-offs. So you gave him those write-offs as well. Are you with me so far? Not that you're in the business of generating trading losses. Are you with me so far? He might want them. And so therefore you did. You generated for him, look up, $6,000 in capital losses. Because when you sold stocks, you captured a sale price per share that was lower than the cost basis per share or adjusted. Are you with me so far? Yeah. Mr. Johnson, I got exactly what you need. I got $6,000 in capital losses for you. Let's give that to the IRS as well. How much do you make a year? Look up, $50,000. Okay. Not really a player in the market, but I'm here to help you. Who knows, maybe we'll get to that point one day with me. Mr. Johnson, you can take $3,000 of the $6,000 in any tax year, no more than. There's a limit. And use it as a write-off on a dollar-for-dollar basis against earned income, and you're only going to be taxed on how much? $47,000. The lower the amount that you taxed, the lower your tax liability. So instead of being taxed on 50, it's going to be taxed on 47. You took $3,000 in capital losses. 7. 3,000 is the number. You got to know it. There's a limit. As a write-off against, look up. 7. Earned income. Am I right? Yes. What's your excess? 3,000. What were your total losses? 6. So what are you going to do with the other 3,000? You're going to carry them forward to the following tax year, 2010, assuming he earns 50 again, and use another 3 as a write-off against earned income. You will continue to carry forward these capital losses. Are you with me so far? Yes. That means it's true. You will continue to carry forward these capital losses. Look at me. If he through you generated, just if you will, $9,000 in capital losses. Take 3 of the 9 in 09 against 50. 3 of the 9 in 09 against 50. He's taxed on 47. That leaves what? $6,000 of excess capital losses. Take 3 of the 6 in 010. In 011, let's assume he still earns 50. Take the remaining 3, he's taxed on 47. You will continue to carry forward. The client may not write off, according to the IRS, any more than $3,000 in capital losses on a dollar-for-dollar basis against earned income in any one tax year. Any excess capital losses are, watch the language, excess capital loss carry forward, another 3, next year another 3, next year another 3, until he no longer has the deductibility. Am I right? You may not write off any more than $3,000 in capital losses on a dollar-for-dollar basis against earned income in any one tax year. You have a limit. What is your limit? $3,000, no more than. Am I right? Yes. Against what? 7, earned income. And there, by taking the $3,000, that limit against earned income, you are reducing your tax liability on earned income with deductibility. 7. You come back in 10 minutes, and I mean only 10. I'm going to go into some significant IRS trading tax law rules and regulations and take this to another level. Are you with me so far? Yes. I'll see you in 10 minutes for the trading rules. Thank you.